Have you ever really stopped to think about money? I mean, we use it every single day, right? But where does it actually come from? The answer? Well, it's probably not what you're thinking. And honestly, it might just change how you see, well, everything.
So, where does money come from? If I had to guess, you're probably picturing, a giant government building with huge printing presses churning out brand new bills. And hey, you're not wrong. But that's only a tiny piece of the puzzle. The real story is way, way more surprising.
Okay, so get this. Every single day, the U.S. government prints something like $500 million in actual physical cash. I mean, the machines are running 24/7 just to keep up. That sounds like a ton of money, right? But believe it or not, that's just a drop in the bucket.
Because on that exact same day, over $4 billion in new digital money gets created. Yeah, that's more than 8 times all the paper money printed. This isn't money made of paper and ink. Nope, it's literally just typed into a computer. So if the government's not creating most of our money, who is? To figure that out, we got to go back in time.
All right, so how on earth did we get to a place where money is just typed into existence? To get it, we need to do a super quick history deep dive. Let's trace the journey from, say, trading goats to the financial world we have now.
Okay, way back when, it was all about the barter system, right? You trade your chickens for my wheat. Simple. A farmer's promise for next year's harvest could literally be used as currency. Then, we moved on to stuff everyone agreed had value. Things like grain or even salt. After that, boom, metal coins, gold and silver. They were awesome because they lasted and everyone wanted them. But there's a problem. Carrying around a bunch of gold is kind of risky, and that problem led to a huge breakthrough back in the 17th century: paper.
And this, right here, is where things get really, really wild. Because our entire modern banking system, the whole thing, was basically invented by a bunch of goldsmiths in the 1600s who stumbled upon let's call it a clever little trick.
So, here's how it worked. You've got all this heavy gold, right? You'd take it to a trusted goldsmith to keep it safe in their vault. In return, they'd give you a piece of paper, a receipt that was basically an IOU for your gold, a promise note. And pretty soon, that piece of paper was just as good as the gold itself, but a whole lot easier to carry around.
But then the goldsmiths noticed something fascinating. People weren't really coming back to get their physical gold. Why bother? They were just using the paper notes to buy stuff from each other. The paper itself had become the money. And that's when a light bulb went off over the goldsmiths' heads. A very, very profitable light bulb.
Okay, so check this out. Someone comes to the goldsmith and says, hey, I need a loan. Instead of going to the vault and handing over actual gold coins, the goldsmith just takes out a fresh piece of paper and writes a brand new promise note. Just like that. This new note, not backed by any new gold, goes out into the world and gets spent. And when the loan gets paid back, with interest of course, the goldsmith is richer and money has literally been created from nothing, out of thin air.
And this is the key takeaway. All of a sudden, you had way more money in paper notes circulating around town than there was actual gold in the vault to back it up. It was a system built on confidence. It all worked perfectly, as long as everybody didn't show up on the same day asking for their gold back.
Okay, so you're probably thinking, cool story, but that was hundreds of years ago. What does that have to do with my debit card? Well, here's the kicker. It has everything to do with today. That goldsmith's trick, it never disappeared. It just got a digital upgrade.
This is the big aha moment. Just swap out a few words. Instead of goldsmiths, think commercial banks, like Chase or Bank of America. Instead of paper promise notes, think of the digital numbers in your bank account. And you've got our modern financial system. The core idea? It is exactly the same.
So let's be super clear about this because it's probably the biggest misconception out there. When you get a loan from a bank, they are not lending you someone else's savings. That's not how it works. They do exactly what the goldsmiths did. They create brand new money right then and there, just by typing numbers into your account.
Let's follow the money on, say, a car loan. The bank approves you for, 30 grand. They just type $30,000 into your account. Poof, it exists. You then transfer that brand new money to the car dealership. The dealership uses it to pay their salespeople. And those salespeople use it to buy groceries, pay their mortgage. You see, that one loan just injected a fresh wave of money that's now flowing through the whole economy. Of course, there's always a catch, right?
You can't just create endless money without consequences. If you keep pumping more and more money into the system, but the amount of stuff to actually buy, cars, food, services, doesn't keep up, what happens? Prices go up. It's the classic too much money chasing too few goods. And that, my friends, is inflation.
So, we've established that commercial banks create most of our money when they make loans to people like you and me and to businesses. But there's another character in this story, a really, really big one, and that's the government, which turns out to be the biggest borrower on the planet.
Here's the thing. Almost every single year, the U.S. government spends way more money than it collects in taxes. That gap between spending and income, that's called the deficit. And to fill that gap, it has to borrow. A lot.
So how does a government borrow? It issues something called a bond, which you can just think of as a fancy IOU. Banks, big companies, even other countries buy these bonds, which is basically them lending money to the government. The government then spends that cash. But it has to pay that loan back plus interest. And how does it often get the money to pay back its old loans? You guessed it, by issuing new bonds. It's a cycle that just keeps on going. And the scale we're talking about here is just mind-boggling. I mean, in a recent year, the government spent around $7 trillion. Tax money didn't even come close to covering that. So that debt wheel just keeps on turning, pushing more and more and more borrowed money out into the world.
So let's just pause and take a step back. When you connect all the dots, you see it. Our entire financial system is built on a foundation of debt. Pretty much every single dollar that exists, whether it was for your mortgage or to fund a government program, started its life as a loan to someone.
Now, this kind of system has some serious pros. It acts like fuel for the economy, right? It lets everything move faster, it funds new businesses, it pays for incredible new technologies. But there's another side to that coin. It can cause inflation. It basically requires the economy to keep growing forever just to pay the interest on all that debt. And if things get out of whack, it can be pretty unstable.
Which kind of leads to a really interesting question. What if we were more deliberate about where all this new money goes? Some argue that if we focused all this lending power on things that create long-term value, things like brand new businesses, better education, modern infrastructure, we could get a much bigger bang for our buck, for society as a whole.
So that's where we land, in this incredible and kind of strange reality. The very money we use every day is born from debt, and the whole system is built on the idea that we have to keep growing forever to sustain it. Which leaves us with one last massive question to think about. In a world built on debt, what happens if the growth ever stops?